Welcome back. This is the third part, and thankfully the last part of our analysis of stocks to look at in March. We have divided it into three segments because there's a lot of stocks on most people's watch lists that number into the hundreds, and it's easier to just try to segment them out a little bit. So for now, I am ready to show you part three. From the top on this particular watch list, what we are finding are similar suspects. We've noticed that the volatility index for the Dow and the volatility index for a few other stocks like Amazon and so on, um, which are traded on the stock market, were high on another watch list. Natural gas was found on this watch list again. Science Applications International, SAIC, a big government contractor, also sponsors the Washington, D.C. soccer stadium, I believe. Well known in the Washington, D.C. area. Napco Technologies, pretty well known company. T.com, an Asia company. Calvista Pharmaceuticals, Akamai, a technology semiconductor company, made a 7% gain. These gains seem to be more well within a what amounts to a more normal range than the other watch lists where we saw a lot of stocks making 15% gains. Here, we don't really see that. So again, the rationale we're using is looking at a watch list from various sectors and comparing their performance. Uh, Gives you an idea of the breadth and depth of this market. And it also gives you time to relax, breathe, and say, look, I may have done okay in the past or not so good, but now I'm going to, maybe use other resources, slow it down a bit, improve. And the only thing you're doing is gaining more experience, which means you're naturally going to get better. The approach that I take is statistically bound. I have an IT and math and stats background, so I take my time. I'm cautious, and I will say that I've learned, you know, proving moves right is how you do things. Like, how did it happen? Why did it happen? So first, I look for stocks with big moves. I've said that over and over again in my videos. And big moves tend to follow stocks that have a lot of volatility. Those are the ones that help for swing and day trades. And while I am primarily a swing trader, it is important to note changes over time. This is a weekly interval for the stock market. It's part three. We've identified technology, natural gas, and volatility as the big movers again. And then what we're going to do is we're going to look at the bottom 10 and see how is volatility affecting stocks on the bottom side. I imagine a little bit more, but we'll get there. So you'll notice some tickers are mentioned to the left on the slide. And the reason we're leaving those up there is it doesn't hurt to look at those other big movers with high volatility on the downside from the previous watch list. Volatility was fairly high. Stocks that were at the bottom were Vistra, an energy play. They've been cited as being related to the data centers in some cases, so I have it on my watch list. We see that to the downside, NetApp, an IT company, wasn't doing so hot, dropping to about 90 from 125. Don't know what the news is on that. I will say that stocks with precipitous moves and volatility should be watched for news in case they're going bankrupt, merging, or whatever. Um, Volatility, as a reminder, is the fluctuation in the price over a short amount of time. Um, which is to say it's an indicator that either there's a massive move happening in the stock market for economic reasons or news, or otherwise, whether it's bankruptcy, bad news, etc. You want to watch those stocks to avoid them generally, or if it's a temporary move, a temporary fear, you want to consider buying it to the upside, right? Those are typical analogies or strategies, either get out or get in. People will eventually pile back into big stocks, so you probably want to keep an eye on the big stocks, and I consider big stocks to over 100. So Vistra is going to be on my watch list. NetApp is going to be on my watch list. Both trade over 100 toward the bottom. United Airlines is towards the bottom. It's something that's going to be on my watch list. It dropped 17%. Yeah. So that's how we structure our week. We look at various stocks to the up and the bottom and see what's an outlier and how to proceed. I don't really see anything other than Western Digital as a precipitous fall. That's worth mentioning as a big stock. But this is helpful information because it looks really like the technology, but specifically semiconductors got hammered where some technology and software companies did better. All right, there's a lot of diversity in that market. You got to make sure that you don't just freak out when you hear news because the news is trying to generally talk about stocks, okay? Unfortunately, they're so tied to the heavy hitters that if Nvidia has a bad week, the entire stock market's going to have a bad week. Couple that with Tesla that had a bad week, and the idea that there's doubts about tariffs. Like, people are going to tell you to stay out, but there's some stocks that are doing well, and you just got to focus on those that you're comfortable with on a watch list, and you'll notice there's diversity of opportunities to the up and downside, despite what people are saying. Let's look at those that are right there in the middle, because those represent stocks that weren't affected too much by vol. So as I proceed to look at the stocks that are right there in the middle, you'll notice Apple's the one that really, I guess, in my opinion, is the most notable one. And Apple is there at row 88. Apple seems to be stuck in that 238 range. Stock that's been stuck in a range for a week to me suggests this stock isn't going to be influenced by the market. It's too big. It's a stock for safety. When people are scared and don't know where to park their money, they're going to throw it into stocks like Apple, correct? Does it go down more? Maybe. Does it go up? We don't know, but that's certainly a stock that we should look at. In fact, we should probably analyze it in this video. I choose one stock per watch list to analyze. You can use the approach on any number of stocks that you like. Just showing you how I do things. Again, we're going to look at the stock. We're going to look at the volatility in terms of volume and movement. So whenever there's movement, there's usually volume, but volume is usually affiliated to fear and indecision. So you'll see on the charts when there's high volume, it means the stock is at the bottom of a range or near the top of a range. And that's very important because without ranges, we can't predict where a stock is more likely to settle. And that means you'll over or underestimate the price in the future, which is a bad thing. So that's what I do to estimate where a stock is going. I always choose a expiration date and price that's within a couple of weeks and the price within the expected move. You should learn how to calculate the expected move in your free time. And if it's a volatile market, it's going to be a bigger expected move with more premium. So you're trying to look at stocks that are more affordable and how to fund them. We'll go into that at another time. So without further ado, let's continue looking at stocks right there in the middle. Platinum seems to be holding up while gold is going up and silver is tracking up. Google seems to be within the flat range. That's a stock that everybody's got their eye on. STM is a famous semiconductor company. ExxonMobil stuck in the middle, and Choice Hotels and Microchip stuck in the middle. I do have an interest in Microchip, full disclosure, and if you read the news on that, it's been pretty good. All right, so let's look at Apple and see what we find. So without further ado, I'll take you to the slide I'm looking at for Apple. There's a lot of information on this chart except for the price. So I'll tell you the price is closing right around 240. It's gone as high as 247 and as low as 230. But the purpose is just to show you in general what the stock is doing. That's where you like to start. I've drawn some vertical lines for you. Those vertical lines are where there was a high buy signal. So if you look at the price during these times of high buying, well, from top to left, at the end of February, it wasn't able to sustain a price, again, close to 240. And just double check that on my end, 245-ish. Wasn't able to hold up at that 245-ish price, but it did trade in a range. So I'm always looking at the breadth and depth of a range because it tells me where it's likely going to have a new range. The extent of range is the top and the bottom. This is 250 and 245, $5 extent on range. Important to note. So we have a high activity at around that 247 range. That's between the 245 and 250. The range changes. As you can see, there was some selling after that initial buy. The selling brought the price down to a new range starting at about 240. 240 to 245 is the new range, and down obviously to 235. That's where we are, right in the middle of that range. However, it's poked its head below the 235. But again, the range started at on the left from 250 to 245. It then went from 245 to 240, uh, and then it dropped from 245 to 240 to 240 to 235. That's where it is right now. So what do we have to work with? Range. We know this price is comfortable at 235, 240, and 245. Again, pretty simple trade. I'm going to suggest the stock could go either back up to the top of the range at 245 or down to 235. It's what we did with eBay. Let's hit it. All right, so as we were doing with the other, stocks that we've examined with interest, we're looking at its ticket. The ticket in this case for Apple, which is trading at 238.65, is down toward the bottom. So 230 is where the stock I want to consider a price range of. So I'm going to buy a put. I believe the stock could very well go down to 230 and as low as 227. That wing is going to cost me the difference between 121 and 88, or 40 bucks, looks like. Um, so that would a 40-buck price is what I'm willing to pay for, first, uh, you know, owning that vertical put and then selling the put below it to finance it. So my total is $9. I believe the stock will go from 230 to 227.50. That's a $250 net potential gain. Should it close at 227.50 on Friday? I just needed to get to that 227.50 price at some time between now and Friday and sell it before it gets to that price. Um, and I'm only paying $9. Okay. So as we've done with other stocks that are kind of in a flat range and have high volatility behind it, it could go up, it could go down. And because the volatility is slowing down, the premiums are slowing down. So when the stock's been flat, like we saw with Apple, Apple was trading flat, no much of a change over the week. I decided to say, let's take a look at it. You could look at this or Google. Any number of stocks that were flat, you would say if there was volatility before it, it's possible it resumes, in which case you could say the stock could go up or down. So I'm looking at it in the positive direction on this slide. I'm buying the 245 call. 245 call means if the stock uh, goes up to 245 or higher, I make money. Okay, and that option naked is 150 bucks, 151. So I'm going to cover the expense of that by selling the 247.50. That means effectively that I have to sell the that I have to agree to limit my gains should the stock go to infinity to whatever 245 to 247.50 is, or 250 bucks. 90 cents is what that one's going for selling. 150 minus 90 is a total of 60. I'm paying 60 for the spread from 245 to 247.50, but I'm also tying on 247 to 250 for a credit. You can look up what credit spreads are, but they are effectively a hedge where I believe the stock will not go as high as 247.50, and I have to buy it if it does go to that. So they're paying me the difference between 90 and 52, which is 40, right? So I'm getting 40, but I'm paying, 60 for the other one. So I'm paying 223 net.